I mean, the first 10 or 15 years of my career was in 0 to 1 venture-backed, primarily tech or tech-enabled startups. And I looked up to the Mark Zuckerbergs of the world. At 22, I thought I wanted to be Mark Zuckerberg. Today, I'd love nothing. I'd rather die than be Mark Zuckerberg. But yeah, I mean,
a little Zuckerberg money.
Maybe I'll take a little bit of the good, but none of the. But yeah, I mean, early in my career, that was I love 0 to 1 company building. I love the craft of like how do you will a new company into existence? How do you raise a gob of capital and go deploy that capital to go drive growth? And I had a couple of successes, had a couple of flops, and eventually I grew really, really tired of what I now call the arrival fallacy of tech. I felt like every project I was working on, I was trading my work-life balance, my sanity, my relationships, my hobbies, in exchange for a 3 to 5 year push to go build something and ideally exit it. And even if it wasn't the 3 to 5 year exit push, it felt like we were always like sprinting toward the next tranche of capital to go raise the next round of financing. Because when you're building a company that has fast growth, you're not default alive. You're living off of the last round of financing, and you're always chasing down the metrics that you need to go unlock the next round of capital. And I spent the first 10 years of my career really entrenched in those circles and loving everything about 0 to 1 entrepreneurship. And that's where I cut my teeth as an operator. And then eventually I took a long backpacking trip with my now business partner and best friend, Adam. This was 11 or 12 years ago. And we were on a long hike in the Utah desert. And we were trying to decide, how do we change this game? Like, we're tired of playing this game, but we love entrepreneurship, we love company building. And the genius idea we had was, well, we'll just start a small lifestyle business and we'll siphon cash. And even if it's only $3,000 to $5,000 a month, like that's enough to extend our runway. And we ended up starting Taylor Cooperative, which is the first company in our portfolio. And what's funny is we grew it actually quite quickly. The intention was to have a small, physical, tangible, like brick and mortar physical business, like a small business where the goal wasn't to be $1 billion company. The goal was to run it well, be an anchor in our community, run it profitably. And that became the first kind of project. We started it with the intention to keep doing moonshot ventures. And eventually we fell in love with small. And that business, I can get to the rest later, but eventually we were throwing off enough cash flow that led to acquiring a second, which led to acquiring a third. So now we have a diversified portfolio of 5 companies in Utah. We've done a bunch of acquisitions. We've done a little bit of startups. But yeah, that's Decada Group. So Decada Group is a diversified holding company, entirely self-funded. We don't have any funds. We haven't raised any capital, committed or otherwise. We use the cash flow of company 1 to go acquire 2. Companies 1 and 2 funded 3, 1 through 3 funded 4, and so on and so forth.
But interestingly, in your model, as I hear you explain that, it's still very much complementary to what you loved about that earlier part of your career, in that, you aren't, or correct me if I'm wrong, but you aren't operating any of your portfolio companies at this point, right? So you really were with Taylor, kind of the get off the ground, get it 0 to 1, bring in an operator, and set your sights on number 2. Is that kind of how it evolved? Is that?
Yeah, I mean, in slow motion over 5 years, but yes, yes, ultimately, yeah. And I think we've been able to kind of have the advantage of, because we didn't have debt on our first company, and we have 3 companies that have no debt. I think last year we issued distributions at 16% of total revenue. So like we're operating in a very lean, like low debt environment, but we're able to go reallocate the cash and go hire, senior management, whether it's a general manager or a CEO, based on the size and the scale of the business, and do our best work in support of our operators. So we've been in the trenches, and I love being in the trenches, and I respect, operators, because that's where we got our start. Today, my day-to-day is we're very much the, hopefully, first call when there's an issue in the company, and Lord knows there's issues in every company every day. We want to be the shoulder to cry on. We want to be in those whiteboard sessions. We do quarterly board meetings, and me and my team at Decada Group, we're in support of our operating company.
Yeah. So Danny, contrast that, right? So you took a completely different approach. So you raised committed capital before acquisition number 1. So what led you there, and maybe a little bit of your career story arc, because I think Sterling is sort of an extension of what you've done for most of your career.
Yeah. my career is a lot less interesting than Chase's.
I disagree.
Got a job on Wall Street out of college. Got a job on Wall Street out of college. And I remember I was in the M&A group for Merrill Lynch, and the first deal that I worked on, we sold this airline payments business for Accenture for $850 million. And I was so proud of that project. There was an announcement that was deeply embedded in the Wall Street Journal, and I sent it to my family.
Page
And
34A.
yeah, and then I got to work the next day, and it was clear to me that nobody in our group really got out of bed for deals that were less than $1 billion. So I worked on the smaller deal because I was the new guy that didn't know what he was doing, but had a great experience there, but was very much, part of a much larger machine. And even then, I would get myself in trouble for having opinions and, being like, hey, what if we did it this way? No, we have teams for that, so from there, got recruited back home. There's a prominent family in Salt Lake called the Eccles family. And they were at this kind of intersection in time where they had, in recent years, divested their last operating company. They had a bank that they sold to Wells Fargo. And and most of their wealth was held in all these philanthropic entities. So they were in the process of saying, hey, we've been LPs in a lot of different private equity funds. They had some family members that were former partners at Carlyle, family members and friends, and a senior member of Lucadia, which is a very well-known holding company. And got together with this idea of, let's create this private investment company that serves families like us, like the Eccles family. So I was very fortunate to just be part of that initial team. And since they've been very successful at that endeavor. But a very similar experience there, we were targeting companies that were quite a bit larger than companies that I invest in now, but we found this very niche software business in the utility space. It was doing about $4 million of cash flow, and it was an opportunity that was almost too good to pass up, but didn't really fit anywhere. Yeah. So we made the investment anyways, and it became my favorite project while I worked with the family. And we stepped in, and we were able to get very involved. And they gave me kind of complete autonomy because it was kind of our smallest holding, and it kind of was just tossed over to the side. And what the company did is they would provide forecasts for power utility prices, and they had these very rich data sets that you could zero down all the way to a zip code level. You could forecast power prices 30 years in the future with this pretty detailed Monte Carlo simulation. Anyways, it was a mission critical service that they provided to utilities and some of the nascent players in the utility space. That's a long way of saying that this business was virtually indestructible. And because we were investing mainly through non-taxed entities, philanthropic entities, the Eccles family really couldn't actually participate very much in the deal. So we had to go out kind of around Salt Lake and put some capital together to do the deal as well, which was part of me kind of thinking about raising committed capital. That was probably the first time I got to exercise that muscle. But as we stepped into the business, it was a 50% cash flow margin business growing at 10% a year. I remember this chart I put together that overlaid the S&P 500 over a 25-year period. And you saw, multiple troughs and peaks, and then this company was just like almost a linear function, And but despite that, there was massive opportunities in the business, and we said, how do you think about pricing the service that you give these utilities? Like, they can't live without this. And after some work, we found out they were 500% underpriced from some of their competitors in many cases. And then we said, how are you finding customers? They're like, well, we don't really they kind of find us, and so had no sales function to speak of. And then there was a huge swath of the market, call it kind of smaller utilities that really they weren't serving either. And so that was just a long way of saying there was just tons of opportunities to add value in the business. And because it was this kind of non-core, kind of orphan in our portfolio, we ended up selling it about 2 years after our investment. And I had really mixed feelings about it. We sold it, and it was an excellent return. We had a triple-digit IRR, but I felt like we were just getting started on a lot of the stuff that we were working on. And I mean, it's easy to play Monday morning quarterback, but that business actually sold. So we sold it to a pure play competitor. They didn't do any more M&A. We bought the business for a little over $20 million. We sold it for about $60 million, and they sold it 2 years ago for a little over $1 billion. And they didn't do anything different than the things that we were already doing. And so that was a very impactful experience for me. And as time went on, while I was there, I found myself wanting to recreate that experience. But we kept bringing kind of more capital in. The plan with Cynosure Group was the name of our company, was being executed as everyone thought it would. But we started making investments that were larger and larger and larger, and I felt myself kind of getting further and further away from the businesses, to the point where that, combined with really a strong desire to do something entrepreneurial, I sat down with all the partners there and said, hey, I keep bringing these businesses that are too small and getting shot down in investment committee. I think I want to just go and buy these myself. And little did I know, that was a backdoor into this whole community that already existed, which was in search funds, that I didn't really know. I didn't go to business school.
You were the genius
and,
first.
And I remember doing all this work and being like, yeah, there's these businesses that are undercapitalized, and a lot of people are retiring. And it's like, yeah, people have found this thesis separate from me. But what I did realize is that having capital is a massive differentiator in kind of the lower end of the market. And then what is also a massive differentiator is oftentimes independent sponsors, they'll invest in these businesses, but they come from that background where, hey, send us the financials every month. We'll do the board meeting every quarter, and there's a lot of complementary benefit to having support in these businesses that doesn't exist otherwise. And that, in addition to, I think, a lot of structural advantages, really lends itself to a Holdco. And that's how I landed on it. And I will say that was part of the ethos of the Eccles family as well, is they generated their wealth not over a 3 to 5 year hold. They generated their wealth over 150 years, And so oftentimes those businesses are built over long periods of time. So that was late 2019. So really have been doing this kind of model since, right before COVID happened until today. And then most recently is Sterling Heights under that banner, and we have kind of 2 platforms. So that's how I ended up here.
No, that's great. So let's talk a little bit about some of the structural trade-offs then, just to keep going with that, because you mentioned one of the primary benefits of raising committed capital. It's a big differentiator. If any of you were in the sourcing talks, right, like 75% of the content in deal sourcing is like, how do you get a broker or investment banker to take you seriously, and things like that. So tons of benefits to having committed capital. That said, you now have committed capital, right? And you've got obligations, you've got things to do with it. So let's maybe talk a little bit about the stressors of each of your structures, and how. So Danny, just to keep going with you, how do you balance that side of the equation of like, okay, I've raised a bunch of capital, you've been able to start, through acquisitions 2 platforms, but it's still, that's a fraction of the capital you've raised, I assume.
Yeah.
So you've got some pressures, right? Like you have to be out there acquiring, whether it's new platforms or rolling up your existing platform. So how do you balance that, and especially balance it with the pressures of making the right investment decision of this is the best business, as opposed to, man, I really got to take another swing for my LPs?
Yeah. Fortunately for us, we were fairly deliberate in the capital that we took on, and so we had a very clear objective that this is a long-term vehicle, and so I mean, people just like the Eccles family, which are now investors of Sterling Heights, had, like, I would say that was part of a filtering mechanism for limited partners. Is there was a lot of investors that it was kind of a non-starter for them, that it's like, hey, this is a long-term permanent vehicle, my path to liquidity is going to be a little bit more opaque. And so I also think there's a big part of it is a lot of our partners are people that we've known for a long time as well. And so because I think any type of private investment, there is a level of trust that goes into that. But that's exactly right. I know exactly how much of the fund that I've drawn down and exactly how much I need to deploy. And I would say the bigger issue of the trade-offs is not necessarily the pressure to deploy, but making sure that we're reserving enough to deploy across our platforms.
Got it.
Is we tend to be in areas where we have long runways to grow via acquisition, and making sure that we have enough capital to support that.
Yeah. So then contrast that, Chase, the opposite. So you don't have committed capital. You relied on cash flow from business one to fund business two to fund business three. How has that impacted? And I know, only because I work with Danny, how rapidly acquisitive they've been able to be, in large part because you have committed capital. How has that impacted? Have there been, I guess, a targeted question, have there been instances where you've wanted to move and capital has been
Totally.
The handcuffs, right? Like,
Yeah.
I've got to pass on this opportunity because the cash isn't there.
Yeah, that's the major disadvantage for us. Is I think we could have scaled a lot quicker and made a lot more acquisitions if we were bankrolled, right? And so that's the obvious disadvantage. I think we could have bought bigger deals. We could have bought, but I think, like, the advantage on the flip side is the ability to be patient. I haven't seen a well-priced deal in 3 years. And like we've, instead of acquiring, we went in 2.5 years, we bought 4 companies, and we can move at that rate if times call for it, if we have the energy for it. And then I haven't bought a company in 3 years. We've looked at a lot, we've taken a few at bats, but by contrast, we've started 2, and we're working on a 3rd that we're starting. So we're able to greenfield, we're able to do de novo, we're able to kind of underwrite to our own terms. So I think, like, Adam and I, we're a little fiery. We're a little independent. Like, I didn't want to leave entrepreneurship for a job. Like, I didn't want to be, beholden to LPs on some kind of acquisition or return timetable. We believe very firmly. Your story is exceptional. Of, like, you had a beautiful business that if only we could have held on to it a little longer. And I think, like, I published our 5th annual letter a couple months ago, reflecting on 2025, and the theme for me was reflecting on one company that's turned 10 under our ownership, and then reflecting also on an electrical contractor we bought 4 years ago that turned 30. Man, things don't get good till, like, year 5, 6, 7, 8. It gets great at year 10. And, like, it was, the first few years suck. Like, the first few years are so hard. The J curve is real, operationally, financially. Yeah. And that 3 to 5 year return window has never brought about a positive pressure earlier in my career. It's only brought about stressors and timetables that I think don't make sense for kind of what we're trying to do, which is, and to be clear, I don't stand on this preachy pulpit saying, like, you shouldn't raise capital and there's never a time or place. But Adam and I were very clear with each other when we started we wanted to create a day-to-day we don't want to retire from. We enjoy our work. This is the craft of what we want to do. We want Decada Group to be around in 30, 40, 50 years from now. And some of our best companies looked pretty damn awful in years 2 or 3. And so, like, I think the ability to stack and compound and be patient is kind of the advantage. And so, yeah, there's real trade-offs.
Yeah, I would also say too that the compounding is just not is not only financial. There's real knowledge compounding, like you said, as you
Totally.
as you get into a business and you start getting your arms around it, the typical hold cycle, then it's time to sell it, and then
Right.
and then you got to start over.
Right.
Yeah.
To be clear, I'd probably be driving a nicer car if we raised a fund and if we were acquiring larger companies and doing it at that volume. Like, I think there's more kind of money to be made. We could go build higher enterprise value if we pursued that route. So I think the downside also has been we've had to be very careful of stringing along the right acquisition at the right time and not getting in over our skis. And it only feels like Decada is 5 years old. It really only feels like our own holding company is starting to gain traction on like the earnings power, the flywheel of that, at 5 years in. And so the first several years were a lot of sacrifice of, we could have swept cash and maybe bought a cabin, but instead we swept cash and we went and we bought a really shitty company that we had to work our tails off for 3 years to go turn around. And so like it's there's pros and cons to both sides for sure. Yeah.
Let's talk a little bit, and I know I'm looking at them as I talk. It's going to be hard to see questions, so please shout out. Don't feel like it's rude if you have questions that I'm not seeing you. Let's talk a little bit about the operator model. And this is probably something very similar to both of you, particularly when you're looking at an acquisition, but even when you're kind of doing a de novo in how you think about, to borrow a simple phrase, the right butts in the right seats here. How do you, as you're looking at acquiring or starting a company, think through the right avatar and recruitment process for an operator for a platform, whether that's through hiring or acquisition? Because I have to assume that a large part of, even on the acquisition side, that your screening is, if it's a new platform, is this person that's going to stick with the business the right person to continue to scale the platform, or do I have to replace them? How do you think about that? Is one better than the other? How much does the operator acquisition play into your decision to actually make an acquisition because it's the right person or the wrong person?
Want to take it first?
Sure. I've thought a lot about this, and I've tried both. Yeah, partnering with existing teams and bringing on a CEO day one. Yeah, so we've done both, and there are definitely trade-offs. I mean, part of it is very situation specific, and we tend to enter discussions with founder owners of businesses first asking them what they would like to do.
Mm-hmm.
But we do very frequently have, hey, I want to keep growing this business and I want to stay involved, and that becomes a factor that pushes us away from doing the deal. And so there's an evaluation of the existing team, and then I think for us, we have a fairly specific box on things that we feel like we understand, that we can understand. Hey, this is an industry, this is a business that we could grow, we could bring somebody in and they could execute on that plan. But I would say, I mean, if I'm looking at a business and it's doing $5 million of revenue and it's been doing $5 million of revenue for the last 10 years, I probably don't believe that the team there is the team that's going to be able to grow it to 20. Despite, everybody will sit in front of you and be like, here's the 5 things we can do to grow our business. We can add all these services. We can go to these new markets, and here's these acquisitions that we could go buy. And it's like, well, yeah, you've been working in this business for 20 years and you haven't done it. What makes you expect that we're going to step in day one and be able to be successful doing all of those things? So that's part of the thought process. And then for me, I mean, there's no substitute for a new operator. There's no substitute for somebody that actually has on the ground experience just shoveling crap. And so for me, I found a really nice combination. If somebody does have, you think about the pedigreed career, but I get really nervous if someone has a pedigreed career, but they've never actually stepped inside the doors of a small business, because it looks and it feels very different. And oftentimes there's things that are the right thing to do for the business that aren't the most efficient like automated things that you can do, but they're just what has to get done to advance the ball down the field. So we really look for that in new operators. It's somebody that actually has that experience and they're seeking it. Because otherwise it's going to be a little bit of a revelation.
Yeah,
it's going to be very different than working at Payne.
I had this discussion with a lot of MBA buyers that are like, yeah, I'm buying a commercial cleaning business doing $700,000 of EBITDA. And my very first question is, how comfortable are you on the Tuesday night when 2 people on your crew don't show up for work, scrubbing toilets in the Bank of Utah's branch downtown? It's a lot different than the $850 million. Yeah, it's different stakes.
Right.
What about you, Chase? How have you approached, and then especially on the de novo side too, because then you're recruiting to kind of hand off your baby, so to speak.
Yeah, I mean, I'll say de novo and established are 2 very different CEO types. It's a very unique skill set to be able to go from 0 to 1, and to go build and go get to like these 50, 100% plus CAGR. Like that's a very different persona than someone who's really good at stewarding an asset and growing it in a slow and compounding way. I think our model is such that we don't need to force any one company to hit certain growth targets for Decada to be successful. We can do quite well just compounding with inflation, and we can go stack our wins in other bets or just over time by compounding acquisition. So we have some companies where the operators' goals are, maybe not as ambitious as we might find if we went and recruited a different CEO, and that's fine. That works with the model as long as it matches with what we're okay with. I think it's very important for us to get the right CEO in alignment with the right business. So if this is a business opportunity that Adam and I are just amped on, and we feel like this industry is going to go grow and we can go 10x this thing, that's going to change the kind of CEO we're going to go find. But yeah, I think one of the most upstream decisions that we make that dictates our success downstream is the kind of CEO that we put in place, and are they the right person for the job? And that comes down to matching them to the industry, matching them to the size of company, matching them to the growth trajectory that we're shaking hands on pursuing. And every CEO's personality is very different. I think we've learned that there's a lot of different great CEOs. They share some commonalities of humility. They share some commonalities of being really high EQ, kind of great at taking complex things and simplifying them and communicating that to the team, communicating that up to us. So there's certain things that we look for, but it's rare that we'll take someone that we've never met and put them in the CEO seat. We don't do that if we can avoid it. Usually, like we have right now, this joint venture that we're working on that we're really excited about, we would actually ask the CEO of one of our companies to come and potentially move over for this opportunity, because we've been around him for 2 years. The president of one of our companies, she started 5 years ago with us as a part-time associate, promoted to assistant general manager, promoted to general manager, and then asked to take the operator seat when we transition CEOs. So we like spending time with people. And when people get what we're all about, they know how to communicate with us. We're kind of aligned on what we're here to go do. That's really valuable for us, and we like to think that there's a world where people can be on a CEO track anywhere across our organization if that's what they want to do ultimately.
Well, and I may be incorrect in remembering the details, but I also think, and part of that story can be when you identify a good operator, it can inform your thesis, because if 100%. I recall correctly with Taylor Cooperative, you opened your second location in Chicago in large part because you had such a great person that wanted to be close to family.
Yeah, no, I mean, and that was the real story. I'm surprised you remember.
Person, so let's just open a location for her to.
Yeah.
Am I?
No, you nailed it. She came and she quit. She said, listen, like we just had a baby. My wife and I want to move back out to Chicago where family is. Like, I'll give you, a year. Like, you've been really good to me. I'll be really good to you. Let's figure this out. Like, I'll help you find a new CEO. And I'm so bummed because this is like, I saw myself spending 10 or 15 years, really doing this. We're like, oh my God, okay. And then a week later, Adam and I were like, well, what if we just go to Chicago with her? And that led to us opening a second location out there. And I mean, when you get the right person, we break all rules that I opine on panels and that I write about of, we'll get them into the economics. We'll find, Exactly. When you find the right people, because the hardest part in this business is always people. It's always people problems. All we do all day long is solve people problems. That's all we do. And so when you find people where it's just like, you know what, I love working with you, and I want to spend the rest of my life building with you. I want to watch you build wealth. I want, as you succeed, I think we'll succeed. We'll break all rules in order to make like the people side really make sense.
We do have one question.
Yeah, I mean, I think this is a really interesting topic that you're both touching on, and one of the hardest things in business is hiring. So I'd love if you could each speak a little bit to what your process looks like, what you're looking for when you're running a hiring process, and how you have conviction making strong hires.
It's a great one for you to take a first step at.
So let's break that up a little bit. So just generally hiring.
Well, you're talking about, you're talking about who you find a really great person. Like, how do you find a really great person? How do you hire someone and have conviction that they're going to be great? What are the questions you're asking, or what are you looking for? You mentioned about like someone who's willing to talk the shit, but like, how do you identify that in the hiring process?
Yeah, I mean, I wish there were magic questions. The short answer is I don't think anybody bats 1,000 with hiring, and I in a lot of cases I think some of the people that I've thought interviewed the best end up not performing, and vice versa.
I agree.
And so I think the perfect situation is what Chase mentioned, is you have people that are already excelling and you're familiar with each other and you've had time to kind of like know what they're good at and what they're not good at, and grow. I mean, that's the perfect situation. So I would say the Mount Everest that we're looking for is that, the majority of people growing in our organizations are growing from within, but oftentimes we inherit businesses that need leadership. And so for me, I mean, you try to solve for that as much as you can through reference calls, through, digging into their past lives. We have kind of a relatively robust process that we go through, that our interview process doesn't happen over a couple of days, especially for someone that's going to get into a key leadership role. But if there's some way we can spend more time with them, and I would say one of our most successful CEOs that we've brought on to a business wasn't the CEO when we brought him on, exactly as Chase mentioned. He came on and he spent time, and the founder owner stayed and transitioned over kind of a 2-3 year period. And so he had time where he didn't have to make decisions on things that he didn't know a lot about, as he was kind of wrapping his arms around the business. But I mean,
let me piggyback off that, because
yeah.
I have a couple thoughts. I completely agree that I think like a really good hirer and an exceptional hirer is like the difference between batting like 500 and 600. It's like you can spend your whole life trying to get really good at reading people in an 8-hour time period, and like people are going to surprise you every time. And so like as I advise our CEOs and work with other CEOs, it's usually the best way to get really good at team building is to get really good at firing, unfortunately. And it's like you're going to get it wrong, and you're going to have to course correct, immediately once you've gotten it wrong, once you know you've gotten it wrong. I think a couple of other thoughts, though, besides that are, it depends on the role. Like the more senior it is, the less we're hiring people off the streets. But when we are hiring off the streets or off Indeed or LinkedIn, we're challenging our CEOs to go spend a lot of money on recruiting and go cast a really wide net. And a lot of folks I've noticed like struggle to spend to go like recruit, whether that's through headhunters or advertising job roles, and it's just a numbers game. It's the wider a net you cast at the top of your funnel, the easier it's going to be downstream to cross paths with the right person. On senior roles, I'm not shy about it. I keep a list of, I've got 30, 35 people I really want to work with one day. And
Yeah,
I have a spreadsheet, and like there's just a list of people where I know for a fact when the right deal crosses my plate, and assuming things make sense for this person on a timing standpoint, I'll call Susie, I'll buy her dinner, and we'll talk about the opportunity, and I'd love to work with Susie one day. And that's a product of years of networking.
Yeah.
And then maybe the last thought I have is just kind of rapid firing some of this, is the best differentiation is recruiting versus hiring. It's like recruiting is you're out looking for folks who aren't looking. Brand building, you know, we try to articulate what Decada is all about so that when people say, I really want to come be a CEO at Decada, like they know what they're signing up for. Hiring is the very reactive process. It's like when you need a job filled and you're putting listings up. And so I think the best organizations are ones where you're doing a lot more recruiting than you are hiring. But at the same time, hiring's hard. Like no one's got it figured out. It's all people challenges, and it's, you know, being really loyal to the folks that do work out. And unfortunately, just being really, really discerning on the high bar of what you expect for people who are on the team and terminating people when they're not a fit. Yeah.
In our hiring process, we ended up hiring Nathan Hill, and nobody bats 1,000. It's just Nathan's great. I saw another post up. Yeah.
I'm curious, like Jason, you said you haven't seen a well-priced deal in 3 years, and so for searchers, how are you advising folks in terms of starting their own deal for their own business from scratch now versus hiring a search deal? Like, I was curious if you guys have been giving advice.
We're at an ETA conference. No, I didn't.
I mean, it's hard for me to not be jaded these days. And you and I were talking about this. I mean, just things are so much more expensive today than they were 5 years ago. I think like there's an entry price into the arena is kind of the way I sometimes put it, is like for anyone young and ambitious who wants to do great things, I think there's an entry price into it's hard to do great things in life. And so you've got to figure out what you're willing to compromise on. And for some, that's you know, slaving away for a couple of years, working for nickels to get a new venture off the ground in 0 to 1. Sometimes it's absorbing maybe a little more risk than, I guess let me put it a different way. There's deals that we did earlier in our journey that we wouldn't do again because we don't have to. Like I'm glad that it worked out, but yeah, I think like there's a real challenge today with the way things are priced and just the way the overall search ecosystem is operating today. It's tough. I don't know. I think on the other hand, though, I'm seeing I have 4 friends now in Utah who are either have completed a bankruptcy process or in the beginnings of a bankruptcy process post acquisition. And we saw stats from your presentation last night. I think it was 3 or 4% of SBA loans default, and that's only telling part of the story, as you said. And so my advice isn't just like there's an entry fee into the arena, you know, go pay the price and jump in. I think it's complicated, and I think I will say that being really good at running a company is a craft. It's like being an athlete. It's a skill set that takes 10 to 15 years to develop, and sometimes I do get a little tired of searchers who have these credentialed you know, graduate degrees thinking they can jump in and run a business better than someone who has 40 years of running the business. And I think it's about tapering expectations. It's about developing your chops in real time and staying humble and paying an entry price in. And I don't have a lot of cohesive advice on the subject because it's really tough times. I don't know if you have better thoughts on this.
I mean, my actions would say that I found some well-priced deals. At least I've acquired some things, but I would say what I've seen unfold probably over the last 5 or so years is there's been a massive increase in interest in I want to buy a business, I want to run a business, I want to run a search, and I would say what's also coincided with that is the average quality has gone down, and that's just my observation, and so I think everybody that's playing in the ecosystem is filtering a little bit, and so what you have to do is you have to look different. People have to remember you. You know, yeah. And so you can't rely on just one channel. You have to be tenacious. And so I think the same, I would say, for me, I mean, our pitch oftentimes is like, you don't need to do the search, just come, like, we'll find the deal for you. You know, because I do think, you know, acquiring a business, kind of structuring a deal, sourcing, and running a company day to day, those are 2 very different and distinct phenotypes. But I would say the common denominator for someone that does it successfully is grit. And that's, I mean, I think it probably does take a little bit more grit because there's more eyeballs looking at deals, you know? And so trying to find an angle that's unique to you, that oftentimes leads to things that are more favorably priced. But I would also add structure into that too. Those two things kind of coincide, and that sometimes it just comes from relationships, but looking different. Yeah.
Yeah, go for it. Hey everyone, Sonny Reynolds. Danny, for one thing you mentioned earlier, for businesses in the lower and middle market space, like, hey, provide them with capital as well as support, they can truly grow. When you said support, I believe you're looking towards like a board of directors. Can you like extrapolate a little bit further on that? Like, what value?
Yeah. So we don't have any boards. Our businesses are too small for that. We spend a lot more time with them than board meetings. So support, I would say, is oftentimes we provide support that doesn't exist in the typical business of that size. One example is, I mean, we have a CFO that sits kind of across both of our businesses that really is an advisor and a resource for our controllers when they are like, hey, I've never done acquisition accounting because we've never acquired anything, but we've done 3 acquisitions this year. I don't know what to do. And he can be like, I've done this 100 times. Let me show you how to do this. Or we did a refinance with one of our businesses late last year. And they've never done that before, right? Oftentimes we put together a budget, and they've never done that before either. And so we look to provide resources to them either directly from the holding company or just through our network and through people that we can find and touch. Either put them in the business permanently, so someone's not wearing 3 hats anymore, or it's some sort of outsourced resource in any of the major functions of the business that didn't exist before. So anyways, that's a broad way to answer it. Could probably answer it for hours after this, but yeah, go ahead.
Where do you both go every day? Do you physically go to an office? Is your office at your house? Do you have a schedule where you go and visit your children at your
Chase actually lives in Fiji. Well, most people don't know.
what does that look like when you own a bunch of different entities, and like, do they get jealous if you spend more time with one, not the other? What does that look like?
Yeah, I protect my mornings. I do a lot of writing in the morning. I don't take morning meetings. I mean, if all things go to plan, we do quarterly board meetings. We have someone on our team who does kind of weekly rundowns with our operators, just kind of metric reviews, and those flow up to my desk. We do a monthly financial review. But if things are going to plan, our touch points are very infrequent. We've found, kind of piggybacking a little off the last question, like the best thing we can do most of the time is get out of the way. Like, we have 3 jobs. It's buy great companies, appoint really great CEOs, and support them in the way that they need it. And so, like, anytime we're in playing a role, it's just not good alignment. Our best thing we could possibly do is help them go fill the role, help them think about the problem, help them think about who to hire, and let them go do that work. We started our journey on the opposite side. We were running fractional marketing, finance, operations. We were in the guts of our businesses, and the alignments were so messy. And we were propping up a lot of functions that once we took a step back, like, regressed. And so we were overstating or over internalizing profitability in some area, and we've just since moved to the other side of the pendulum. But things never go to plan, and so it's never that operating cadence. We get really involved when things are either going really well or really poorly. So we've defined this concept that we call the box. We go through this annual planning effort with our CEOs every year, where they're responsible for articulating a budget and a plan for the year that we ultimately bless. And as long as they stay within the parameters of the box, 4 board meetings a year, monthly call. I do a monthly sauna session or coffee session or hang out with each of our CEOs. And if things go to plan and you're in the box, that's all you got to do. But if we're out of the box, then, I mean, it's gone so far as, like, if we're having issues, like, I had a CEO go on vacation in Costa Rica and come back with my desk in his office. And, we'll get hands-on if we've got to. Like, our ultimate fiduciary duty is we're the ultimate safeguard. We're the ultimate steward of the long term of the company. And so we have to protect that. But I'd be curious how that's different from you.
So we're huge proponents of the EOS system. So I can see a lot of nods. And so we tend to establish that in our companies, and some of them are already kind of doing it. We find, and we we help get it kind of on track. And that system is, I mean, it's not a silver bullet, but it's a really nice framework to just make sure everybody's kind of on the same page. And then we deliberately, when we set out the structure of the businesses, we deliberately put ourselves in what we call the growth bucket. And then we are a support to everything else. And so the one thing that we do drive and we bring to the table is we say, hey, we'll find ways for us to grow. And oftentimes that means, like, you know, we'll do the work on this adjacent service that we should start providing, or we'll do the work on this new market, or we'll do the work on, you know, this acquisition. And sometimes those things are combined, and we take that and we take full ownership and accountability for that. And then we help them fill, you know, other gaps that exist. And so what that looks like is typically early on is we're very involved, you know, and we're probably talking on the phone, you know, several times a week with key people, and then we have our standing 90-minute call with our companies that eventually they graduate from that too. But we always kind of remain in that growth bucket. But it's more of just we say it kind of similarly to Chase is they're like, how involved are you going to be? Are you going to, you know, is life going to change? And you guys going to be checking on our numbers every week? And it's we're going to be involved as much as we really need to be, but we don't want to get in your way, because oftentimes there's an expertise that even someone that's middle management in our business, but they've been in there for 20 years. There's things. Oftentimes there's their knowledge of the industry. They'll forget more than we'll learn, and we are very self-aware about that, and try to not tell them that we know everything and walk in like we have all the answers. We typically say we have all the ingredients. We just need to put them together the right way. And so, but that EOS framework, and then eventually they oftentimes will graduate from that, but that's a really good starting point. Yeah.
Steve, y'all are aligning with what Christian and John said from the get out of the way. They were talking to people, and it was like, you know, attribute hiring, good training, get out of the way. That's what they said. And so, from an attribute perspective of good people that you're looking at, your list of 30 people, is there a commonality across them of like a single attribute that you say, this is probably my favorite attribute? Maybe it's different between two people.
For our CEOs in particular?
Sorry?
For our CEOs in particular?
Sure, yeah. You can talk more. You can talk general, or
Yeah.
Or you can talk about.
I mean, hiring for a CEO role for Decada, it's a very interesting Venn diagram, because we're looking for the talent and the caliber and the gumption that is someone who would just go do it on their own. And so that's hard. Is like, so you know, if it's someone who has that level of experience and tenacity, they'll never come work for us, even if we get them in the cap table and in our ecosystem. But there's a lot of really high drive, high ambition people who are just very risk averse. And that tends to be the Venn diagram we're looking for, is like someone where either if they didn't have 3 kids and a mortgage, they would go do this, or if they in 5 years from now, they will go do this. So there's someone where they see Decada Group as a bit of an accelerant. And so we look for the right ingredients of that, of just like the economics need to make sense, the experience. But in terms of attributes, I get asked this a lot, and like I've just been shocked at like how many great CEOs are so different from one another. So it's less a personality thing. I think they always share some of the things I mentioned earlier, like really high humility, really, really high EQ. Like really, you're the chief communicator in between Decada Group and the economic interests and kind of shareholder interest, and like the group on the ground that's out doing the commercial cleaning or doing the work, and able to just take really complex situations or problems or high emotion things and make them very simple. But overall, I mean, if like we gather our CEOs and they're just very different people, ages, gender, personality, interests. But yeah, I'm genuinely curious what you would say to this.
Yeah, I the analogy that we use often is we want someone that is entrepreneurial, and maybe sometimes we can get lucky and they're about to jump out of the airplane and we just kind of catch them, you know, before, and that's just a timing thing. But I would say in general, I mean, the way that we talk about it is an ownership mentality, and so the our model, it doesn't work if we have to micromanage. And so, somebody that has that ownership mentality is like, hey, these are the problems, and it doesn't matter whose problems they are. I'm the CEO, I'm the leader, or I like they're the CEO of something, and so that would be probably the one commonality. But Chase is exactly right. I mean, we have a commercial roofing, glass siding, guys building real things, and we have a childcare business, and those businesses,
Totally.
they take very different leaders, but the ownership mentality is common.
If it's a quick answer, we'll do one more. We're at time. Yeah. Ask your question. If we need a sidebar after, we can do that.
Thanks, Kevin. I'm Madison. Nice to meet you guys. What keeps you guys up at night?
It's a great concluder.
You can't say people.
Geopolitical.
You can't say
I mean, I think the biggest moments of crisis are when CEOs depart suddenly. So I think probably that. I mean, I'm sure I'm a little biased coming off of the topic here, but I think, yeah, I mean, we've done a lot to. I think one of the benefits of the model that we've been really kind of deliberate in building is. I published this in our annual letter as well. Our cash to debt service coverage ratio is like a 4.5. Like, we're not debt to the gills. We don't do 90% debt. We don't have shareholders or LPs breathing down our necks. So I think it's a very internal thing, and I think it's as we've grown, we've had to delegate a lot, and we've had to put a lot of trust and authority behind the CEOs that we hire. And I think the biggest fear is like. Yeah, losing a CEO that we thought was good but isn't.
I mean, people is my answer, even though you said you couldn't.
Yeah.
It could be the answer, but I mean, one thing that has caused me a lot of angst is and oftentimes, I mean, when we step into something, we very frequently are partnering with the existing founder owner, and that partnership needs to be healthy. And so when that partnership is unhealthy, that keeps me up at night.
It's hard.
Thank you, guys. They're both around at least some of this afternoon.